Thank you all for taking time to join us this evening. My name's Jack Estel. I'm a lecturer with the Department of Economics, as many of you know. Let me see, we all go further. I know you've been playing with your phones, but I will at least turn mine off, and I'd appreciate it if everyone else did as well. There we go. Also, I would like to have someone from the Econ department, and I think John is going to come up and say a few words about the economics department. Here, John.
Hello. Well, I just want to thank whoever started that. That was kind of cool. My name's John Linford. I'm actually the president of the Econ Club here on campus. This is my VP, Greg. Say hi. This is a good crowd. You're going to be okay. Just to let you know, we've got a couple of really cool, exciting events coming up here in the next few weeks. We've got a resume workshop coming up next week, Friday. If you have any questions, find one of us afterward. We're going to be over at Flames. Of course we are. And then, of course, anytime you're on campus, just swing by DMH 139, come say hi. Usually one of us is in there, and we're all pretty friendly. We don't bite too much. Thanks, guys.
Thank you. Yeah. So following our lecture tonight, we will be meeting over at Flames Eatery on the corner of 4th Street in San Fernando for a meeting of what we call the Barstool Economists. The Barstool is a group of individuals from across the country who share economic ideas on the web. Fortunately, we have many members here in the Bay Area, and it's open to anyone who would like to join. It's a Yahoo Groups. And if you are interested in joining, if you contact me, I'd be happy to set you up. Everyone, member or potential member, and we consider everyone who's here a potential member, is welcome to join us and continue the discussion about banking and economics in general. I have posted the spring 2015 schedule for the other two provocative lectures on the economic website. And I just wanted to let you know Russ Roberts will be speaking here on April 22nd, and Scott Cunningham will be joining us on May 7th. So there are a few details that we haven't quite got straightened out, but you can go to the website, and if you look at future provocative lectures, that information is being updated as we get it. This lecture series started 13 years ago to foster, over 13 years now, to foster our vision of higher education, challenging popular ideas and developing critical thinking in an environment of respectful intellectual discourse. Please relax and listen to Professor Calomiris tonight as he discusses the book that he co-authored with Stephen Haber on banking systems. He will provide a question and answer period at the end of the presentation to allow the audience to explore specifics, and it is our hope that the lecture will encourage a greater understanding of the trade-offs and conflicting interests inherent in banking systems, as well as an appreciation for the pursuit of knowledge more generally. Charles Calomiris is the Henry Kaufman Professor of Financial Institutions at Columbia Business School and a professor at Columbia School of International and Public Affairs. He is also adjunct fellow at the Manhattan Institute and a research associate at the National Bureau of Economic Research. He co-directs the Hoover Institution's program on regulation and the rule of law and is the co-managing editor of the Journal of Financial Intermediation. He is a lifelong fan of Alexander Hamilton and has been happily encouraged everyone to go to New York and see the off-Broadway musical Hamilton, which is currently playing there. Please welcome Professor Calomiris.
Thanks, Jack. What a great introduction. Welcome, everyone. It's a pleasure to be here. I love the title of this group, the Provocative Lecture Series, because I've always felt like my role in the world is to be an adjunct provocateur. And so I hope I can provoke you a little bit tonight. I think all economists should start their provocations with something useful. And my idea of useful things are facts. So I want to start with fact number one. You are living in the middle of the worst pandemic of global banking instability that the world has ever seen. In fact, there's no period in human history that's even close. Not the Great Depression, not the period of financial globalization from roughly the 1870s until World War I, there is no comparable period. If you look around the world, since the 1970s, a short period, let's say about 40 years, we've had over 100 major banking crises, putting aside the former communist world, which had some of its own crises. 100 major banking crises, how do we define that? Well, either a time where there's a huge amount of failure going on in the banking system, or a time when maybe there isn't a lot of bank failure, but a seizing up of the payment system where everybody's running the banks. So if either of those two phenomena happens, we're going to call that a major banking crisis. So by that measure, Luc Levin and Fabian Valencia at the IMF measured how many we've had in the last 40 years or so, and as I said, they came up with 100. But they didn't happen equally all over the world. So some countries had no crises. Only about 29% of the countries had no crises during this period. Some countries, about half of them, had one crisis. Other countries had two or more. Those would include countries like the Democratic Republic of the Congo, Chad, Argentina, and the United States. When we're trying to understand what causes crises, if we turn to economics, we're going to get an incomplete explanation. Not a wrong explanation, but an incomplete one. Virtually every story coming out of economic modeling about what causes this phenomenon of banking crisis sounds pretty much like this. There's a big shock. What's a big shock? Well, if you're in Chile, copper prices are falling. If you're in Russia, oil prices are falling. So something is happening that's causing a recession. Some major shock is hitting the economy. And banks tend to be fragile. That is, they tend to be susceptible to those shocks. Why? Well, first of all, they're making lots of loans. And some of those loans are going to go bad when the economy goes bad. Okay. Furthermore, to make matters worse, people can't really tell what the value of a particular bank's loan portfolio is, because after all, the beauty of setting up a bank is to delegate to the banker the job of figuring out what to do with the money. So bankers don't just hold publicly traded stocks, they hold loans that they've originated and that outsiders have a hard time figuring out what they're worth. That means that even banks that are in good shape, despite the macroeconomic shock that everyone can observe, might be held as suspicious. So not only insolvent banks, but all banks might be held as suspicious in light of this observable shock. And then third, depositors get to act on this shock. Because when they observe this big shock, they can decide to come and withdraw their money. To give you an idea, suppose that I told you that there was a significant chance that your bank tomorrow was going to have to suspend convertibility, tell you that you can't get your money out, and that you were, let's say, there's a 1/30th chance that you're not going to be able to get your money out tomorrow. And that if you are so unlucky as to have a bank that ends up having this suspension and failure, you'll probably lose about 10% of your deposits. So suppose I told you that. There's a 1/30th chance you'll lose about 10% of your deposits. Now, the actual expected loss is about 0.3%, that's a very small loss. But what I found when I asked my students, would you go to your bank, take your lunch hour, and go to your bank and withdraw your deposits? Almost all of them say that they would. 1/30th chance that you'll lose 10% of your deposits. So what I want to emphasize is, even if you had a small inkling that there's a problem at your bank, you might decide to go withdraw your money. Now, that's the story then of why banks are susceptible to big shocks, because they loan money. They do it in an opaque way, And they're also subject to the discipline of deposit withdrawals. And so you can see how the banking system could end up having a crisis where either we get a lot of people just withdrawing their money, or even worse, the withdrawals tend to force banks to close. Maybe they try to sell off some of their loans. They can't sell them because, after all, no one knows exactly what they're worth. They're not publicly traded assets, which means that they have big losses, they fail. That's the kind of story, that's the narrative that economics is telling us. And I want to tell you, it's not a wrong narrative. We can point to a lot of examples of this. In fact, I would say just about every banking crisis that's ever happened fits this story in some sense. Here's the problem. That can't be a sufficient explanation for why banking crises happen. Why? Because if that were true, then every time a country with a lot of banks experiences a major shock, it would have a banking crisis. The problem is that there are lots of countries that experience big shocks and have lots of banking going on, and they don't experience a crisis. In fact, maybe the most dramatic evidence is right next door here to the United States, called Canada. Canada has never had a banking crisis. The first Canadian bank was chartered in 1817. They've had a lot of banks chartered since then. They've actually had more credit relative to GDP, or equal credit, throughout their history relative to the US. And yet the US, since 1792, has had 17 major banking crises, and Canada has had 0. In fact, Canada not only experienced the shocks pretty much at the same time the US did, because we're neighbors, where our economies tend to move together, but Canada is more reliant on primary commodity exporting, which means that its GDP, historically, has been more volatile than the US. That is, they experience more shocks. So we've got a little puzzle here. Two economies, both using banking, both have the loan portfolio of opaque assets, both have demandable debt deposits that can be withdrawn, and yet one of these countries, which has, the one that has the bigger shocks, has no banking panics, no banking crises, while the other country has 17 of them. So you can see why I think that the basic economic story, while it's certainly useful, is incomplete. It also, that's not the only puzzle that comes out of this story. We've had 100 major banking crises in the last 40 years worldwide. They've been extremely severe, too. What's a measure of severity? Well, what's the cost of cleaning them up? So that's the negative net worth of banks that fail relative to GDP. So when banks fail, they have negative net worth, and you have to clean them up. The average for the 100 that we've had in the past 40 years is 16% of GDP. By the way, that is a huge number. The Great Depression in the United States was 2.5% of GDP. Some of the crises have gone as high as 60 or 70% of GDP. Some people would argue that the Icelandic crisis was more than 100% of GDP. But on average, about 16% of GDP. So we've had 100 events where the negative net worth of failed banks on average have been 16% of GDP. How about, I've already said the Great Depression was nowhere near that. How about the period, another sort of comparable period of financial globalization, where there was lots of banking going on too, 1874 to 1913, about the same length of time. How many major banking crises happened worldwide, by my definition? 10. By the way, 5 of those were in the United States. They were really of two different types. One of them was the US crisis, where the negative net worth of failed banks was almost 0. That is itself pretty interesting in all 5 of them. There were bank runs, but there weren't a lot of bank failures. And then there were another 5 that happened outside the US, in Argentina, Brazil, Norway, Italy, and Australia. The average severity of those 10 crises was about 6% of GDP. Now, let's see, I have to remember. About 3% of GDP. The 5 that were outside the US were 6% of GDP. Averaged with the 5 in the US, it's 3% of GDP. So by comparison, the current era we're living through has 10 times as many severe banking crises, and each of those is 5 times as severe as a comparable period from 1874 to 1913. So I hope you're convinced that we have a puzzle on our hands, because that was also a highly volatile macroeconomic period from 1874 to 1913. So here's the strange thing. Over time, banking crises have become much more common, despite the fact that macroeconomic volatility is actually less. And across countries, the US has had 17 major banking crises, while Canada, with more volatility, has had 0. So do you think that this model is going to explain the facts? Of course it can't. The most basic facts. What's interesting, of course, is most economists aren't concerned with these facts, because if they were, they'd be writing down models that would be able to explain them. That is stunning to me, and I think that it's something worth reflecting on. But what I want to do is point out that part of the reason that they're not doing it is because the toolkit of economics is not going to be enough. So you might say, well, what's explaining this? Could it be that some countries just have dysfunctional regulation that just isn't working very well? And the answer is yes. And then you could say, and this is also clear, that we can identify these regulations if we just take a close look. Yes. And is it also true that we don't learn from the mistakes and fix the regulations, despite the fact that we have recurrent problems in countries that tend to experience banking crisis? And the answer, again, is yes. And so you could say, well then, Professor, it's just simple. Some countries have bad regulation. And I say, well, hold on. Yes, good answer. But what kind of an explanation is that? Why do some countries have dysfunctional regulation repeatedly, while other countries don't? And that turns out to be, as you could guess, inherently a political question, because regulation comes from, where else? Politics. That's just as you came from your mama. Regulation comes from politics. And so now you can see how I got into this mess. I'm an economist. I like doing economic modeling, but I don't have a choice. There are these huge facts out there that beg to be explained, and they require us to understand why is it that some political systems generate regulatory systems, regulatory rules of engagement that result in extreme instability and others don't. And so whether I like it or not, I have to become a political scientist, not just an economist. So let me go over a little bit of what my message is going to be for you, broadly defined. So what I'm going to argue is that in some countries, not all countries, or in some periods in some countries, maybe not all periods in those same countries, we end up having a political arrangement that tends to produce unstable banking. And one of the key ways to understand this is, because you might say, well, why would anyone want instability? Why would anyone want to have a dysfunctional regulatory system per se? And the answer is no one would. Nobody benefits from bad things directly. But the problem is that dysfunctional regulatory systems are attached or stapled to things that some people really do like subsidized risky credit. So it's not that people want the bad regulation because they don't want everything to blow up. They want the bad regulation because even though it makes things blow up, it delivers something to them that they want. Now, of course, that wouldn't make sense if we were all equally sharing in the pain of these blow-ups, because as you've already learned from me, the blow-ups are extremely costly. But wait a minute, couldn't it be that some people in the economy benefit disproportionately from the things that are stapled to those bad regulatory regimes, and so they're willing to share in the cost of the instability because they get huge gains from the rules of the game that are established a particular way? So that's, I think, a reasonable political model of why we have these dysfunctional regulatory regimes that persist. They're in someone's interest, and definitely at the expense of some others. And the process that gives rise to these political coalitions that are fighting over what the rules are going to be in the banking system, that process we call in the book the game of bank bargains. It's a game that happens in all political systems, whether they're autocracies or democracies, and no matter what type of autocracies or democracies. And the key thing is to recognize that they're fighting over the regulatory outcomes. What are those regulatory outcomes? Let's not use vague words. Let's be specific. What is bank regulation about? It's about who gets to be a banker, number one. You might say, well, can't everybody be a banker? No. It's about what banks get to do. It's about what banks have to do. Governments charter banks. They decide who can be a banker. They decide what banks can do, and they also decide what banks must do, including what kinds of loans they have to make, to which industries, to which people, on what terms. They can do that, and they do, including what kinds of loans that the banks might have to make to the government itself. After all, governments are in the business of surviving. And if their survival is at risk, I can promise you the banks are not going to be doing much other than helping the government. That's a big story in the history of banking. So the governments can tell you who gets to be a banker, what does a bank do, what does it have to do, but then more. When banks have losses, how will they be shared? Now you could say, well, I know the answer to that. Banks have debts and they have equity. So equity holders absorb the first losses, and after the losses are gone, the debt holders absorb those. Well, that's a very simple-minded view, because there's another thing that you could do. You could decide that when the banks have losses, that is, the loans are worth less, you might forgive the loans. So you might not bear losses within the bank. Or you might decide that to have those losses that are occurring on your loan side be paid for by taxpayers rather than by stockholders or depositors. So that's called the rules about the allocation of loss. Those aren't just legal rules that are written down. They're political rules about how the game gets played, what the outcome is when a loss occurs. And so the rules of the game of bank regulation are on all those dimensions. What people you're going to let be bankers, what activities you're going to allow, what activities you're going to require, and when losses happen, how you're going to allocate them. Those are the things that we're fighting over in the political realm in this game of bank bargains. Okay, now I've talked about the instability puzzle, why it is that some countries have unstable banking systems, and I've suggested that it has something to do with a political game where some people choose instability. They're in the winning coalition in this game of bank bargains, and they choose instability because they get an advantage from it. But I want to now turn to another fact, which is another puzzle. Banks aren't just dysfunctional in terms of their instability, they're also dysfunctional in terms of their incapacity for generating credit. You heard me. Banks are, the world over, pretty much failing in their mission to generate credit. That is their primary mission. Now, this is a simple problem technologically. I want to emphasize two very puzzling facts. Number one, the basic technology of commercial banking, deposits, loans, lines of credit, branch banks, clearing houses, all the things that you're thinking of as the technology of how to run a commercial bank, were perfected by about 1750 in Scotland. So that's about 265 years ago. We haven't really invented anything that important for commercial banking since then. This is not a hard technology to imitate. You don't even need your iPhone or anything like that. And yet, we haven't imitated it. Now, all the more surprising, that great technology turns out in hundreds of studies to be one of the most important things for for solving poverty problems around the world. If you create banking systems where people can have access to credit on arm's length, that turns out not just to promote average growth, but to promote business formation, to reduce poverty, to reduce inequality. It is the wellspring of many good things. You pretty much can't make a list with anything good on it that more bank credit doesn't make happen. Except that we don't seem to be able to generate it, even though we've had the technology for doing it for 260 some years. That is puzzling. What I want to suggest is that the same kinds of political focus can explain this dysfunction too, that we can understand why in some countries there's an extreme scarcity of credit. One thing that's going to be obvious when you look at the data is that this tends to be especially true in autocracies, that is, in places that aren't very democratic. Let me give you a sense of the data here. So this is looking at credit relative to GDP. We would tend to think sort of the norm would be certainly about 40, 50, 60% credit to GDP ratio, and yet you can see that only in the richest countries, and only in some of those, do we get up above that number. You can see in the graph, I hope you can see it, the UK is marked, Canada is marked, and the US is marked as darker black lines, and they're all above that sort of threshold. But if you look over here, let's see if I can get you down there. There's the Democratic Republic of Congo. Can you find the banking system there? Probably not. A couple percentage points of GDP. But for most of these low-income countries, 11% of GDP, lower middle-income countries, 22% of GDP. These are abysmally small numbers. And most of that has to do with autocracy. Most of the extreme credit scarcity has to do with autocratic governments. So suppose now we said, let's put together these two criteria and say, where in the world do we see countries that have managed to both avoid big banking crises in the last 40 years and have even just a little bit above the abysmally low average, let's say a standard deviation above the average for the world, which is a very low number? And the answer is there are only 6. And they have some things in common. The first 3 are island or city-states, very small and homogeneous populations in the sense that they're all living in an urban area. They all have similar sorts of economic determinants of their lives. They're in the same economic environment, very homogeneous. And the reason I think that's significant is they are not places where you're going to have natural divisions between people, where there's going to be a game fought where some group becomes in control and uses the banking system to extract things from the other group. You can't if we're all the same. Contrast, let's say, with the US, where throughout US history, as we're going to see, it was rural versus urban that was typically the big divide in terms of who was in control. Initially, rural interests, and later, urban interests. And whenever they've had control, they've used the banking system as a tool for getting resources from the other group. One of the reasons banking systems are so useful for doing that, especially in democracies, is that they're not so transparent. You can't really see exactly how that system is working. That is, if I have a tax and transfer on the budget of the government, you can see it. But if I use subtleties of the regulatory process to make some people advantaged at the expense of others, it's very hard for you to track it. I dare say that none of you, despite being economics students, really is following it closely enough to be able to see it. So the banking game can be extremely useful for these purposes. But in places where everyone's got sort of the same or in the same economic boat, that's not going to happen. And so I think that's a big part of the story for why half of the countries that are on our list of 6 are island or city-states. What about the other 3? Well, they have a history of being what we're going to call in the book liberal democracies, by which we mean democracies that tend to have constitutions that make it very difficult or unnecessary combination for people to use the banking system as a tool for extracting resources from one group to give to another. We're going to talk a bit about Canada tonight in that light as an example. So even just a simple-minded look at the data tells us that there's something about the political realities of these countries, something about their structures that should affect their politics that's explaining why they're so successful. What about the flip side? Well, on the flip side, when we look at the countries that are extremely unsuccessful, so one thing we could say is suppose that you're a standard deviation below the mean of credit, and you have 2 crises or more. Well, there are only 2 countries in that group, and that's Chad and the Democratic Republic of Congo. What do they have in common? Very poor scores in what's called the polity score, or measure of representative government. So they are autocracies. They're also very violent places during some of the history of this last 40 years. So it's very hard to set up a bank in a situation where you're facing expropriation risk. That's what autocracies deliver for you. Would you want to start up a bank knowing that the military might come and just take everything from you arbitrarily? Or even if it's not the military, that some dictator might change the rules of the game arbitrarily to penalize you for your success. In those kinds of environments, people don't want to create banks. If you wanted to broaden the list to say only one crisis or one standard deviation below the mean in credit, you'd add a lot of other countries, but again, you're mainly adding autocracies. So when we're looking at extreme dysfunction and extreme good function, we're seeing very different kinds of political systems. Here are the basics. So first of all, being a democracy tends to put you in good shape, but not all democracies are created equal. Some democracies, those that are liberal democracies or that are countries where there isn't a lot of natural division within the population, tend to not experience banking crises. So being a democracy is good, but that doesn't mean that so you'll have more credit typically, but you don't necessarily have stable credit. The most obvious example of that is the US, which of course is a great democracy, despite the fact that it has one of the most unstable banking systems the world has ever seen, and has had one for over 200 years. I've already told you those, so I'm going to skip them. Here are some of the questions that we address in the book. I'm not going to review them, but you can see that we're trying to understand these linkages between how these political games work and how these banking system outcomes happen, particular regulatory systems, particular banking outcomes of failures of banks, scarcity of credit. But what we're going to do is we're actually going to trace this very closely in 5 countries. We're going to try to figure out who are in these political coalitions. What actions are they undertaking to affect the banking system rules of the game? And how does that evolve over time? And in these 5 countries. And what we think is interesting, at least what I found, what I learned from doing this with Steve Haber over the last several years, was that we found that the stories weren't that complicated, that the stories weren't that controversial, that you could pretty much connect the dots of who is doing what in which country and why the outcome is different. And so while it sounds very puzzling, how can Canada have 0 and the US have 17 banking crises, despite Canada having greater volatility? It turns out that that's not so unbelievable. The other thing that we learned is that countries that might seem the same from simple-minded kinds of scoring, like polity score that just measures how autocratic or how democratic they are, they're not the same in terms of their outcomes for the politics of banking. And we ended up coming up with about 8 different regimes, 3 in autocracies, about 5 different kinds of democracies. I don't want to go through a list, the taxonomy right now, but what I do want to do is talk through quickly for you some of those examples. Let me start with the two autocracies. These are two countries that throughout our sample period had very poor polity scores. That is, they're typically run by autocratic governments. What's interesting, there are three things I want to say about them. What's interesting is, first of all, they're not the same at all. And from that discussion, there emerged an important distinction in thinking about banking in autocracies. And that distinction is between highly centralized autocracies or weakly centralized autocracies. Mexico is going to be the example of a highly centralized autocracy, Brazil of a decentralized autocracy. So in a highly centralized autocracy, like Mexico, by the way, it's been centralized since before the Spanish arrived. It has a lot to do with Mexican geography. The Aztecs were in control of Mexico from a central position, a major city, before the Spanish arrived. And again, that has to do with Mexican geography. And that persisted. Mexico has managed, compared to many other countries who are autocratic, to maintain a fairly powerful and centralized autocracy through most of its history. Now, those kinds of autocracies tend to develop highly centralized networks of what are sometimes called crony capitalists. Crony capitalists means people who are part of the same coalition. They are generals, politicians, business people, and bankers who are often closely related to each other, sitting on each other's boards of directors, intermarrying with one another. Why do they do that? So that they can create closer bonds that are not so easily broken. And the autocrat is, of course, sitting on top of this coalition. What's the point of having a crony network? Everybody wants to be connected to all the other powerful members of the elite, because the more connected you are, the less likely it is you'll be thrown under the bus. Because the main problem in these kinds of regimes is arbitrary exertions of power by the autocrat. So what we're going to do is have a rent-sharing arrangement where we get to be the elite, and we know that the main risk is either that the autocrat's going to throw us under the bus. Have you been reading the newspaper about China lately? Either the autocrat's going to throw us under the bus, or there's going to be a revolution because we're an elite and somebody might decide to overthrow us. Now, in that environment, credit is going to have to be scarce because the return to putting your money in the bank is going to have to be a lot higher given this high risk. And given this high risk and that high need for a return, you have to keep credit scarce. Otherwise, you wouldn't be able to generate those high returns. So Mexico oscillated in its history between two kinds of regimes. One, crony capitalist networks. Porfirio Diaz is the 19th and early 20th century version of that. And then the PRI in the post-World War II era. But it oscillated between this crony network equilibrium and another equilibrium, which is called chaos. Chaos meaning civil war. Neither of those is very hospitable to lots of credit. So that's the story of a centralized autocracy. What about Brazil? A completely different story. Also an autocracy, but Brazil was a very decentralized one. When the Portuguese came to Brazil, they're establishing sugar plantation settlements along the coast in different places. Later, we have mining being established in Brazil. The connections among these are very weak. Again, it's largely Brazilian geography and topography that's driving this. Brazil, even into the late 19th century, was a very disconnected and fragmented political environment. Very weakly centralized governments. Now, why is that so important? Well, unlike the crony capitalist network where you had this small number of banks controlled by the industrialists and military that are part of this crony network, in Brazil, the problem was that the government couldn't really collect taxes very easily because it didn't have a lot of power, the centralized government. Whenever they would go to one of these remote places, which was controlled by local elites, they found that their tax revenues hadn't been collected for them, and they couldn't really exert much power in those remote areas. So in Brazil, we had the problem of an impecunious national government perpetually. So what do you do if you're impecunious? Well, you have one great last resort for collecting taxes, and that is to charter banks. Here's how you do it. You say, you can't be a bank unless I charter you, and when you become a bank, you are going to take half of your deposits and give them to me at 0 interest forever. I'll take good care of them. I will not be paying you any interest on them. So I get sort of per period that the implied tax is the rate of interest times the amount of reserves that I make you put in my central bank. That's what I'm earning as a tax. That's sometimes called the inflation tax. And of course, the history of Brazil has been a history of very high inflation because governments have used the banking system not to provide credit to the private sector, but to fund the government's needs that it couldn't fund because of its weak political power. By the way, this is also true somewhat differently for Great Britain. Not for Scotland. I already told you in Scotland they were developing banks very early on. But in England and Wales, from 1694, when the Bank of England was formed, until 1825, the Bank of England was the only chartered bank there. And the reason for that was that the Bank of England had a main job, which was to help England win the war against France, which went from 1688 until 1815. And its whole role was to provide credit to the government. And so the government gave it monopoly rights within Wales and England so that it could monopolize savings and channel them to the government. Sounds very similar to Brazil, doesn't it? And it tells us a universal law of autocracies or of any governments that have to use the banking system as their only means of survival. And that is, until the government is safe, private credit can't be created. This is a very important rule. Okay, so two very different stories of why private credit was not created abundantly in autocracies. In a centralized autocracy, because of the need for a crony network facing very high expropriation risk to keep credit scarce. And the other one about an impecunious government that decides to use the banking system to collect taxes. Notice that even an impecunious government can control the chartering of banks, even in remote areas, because you can go there and say, I didn't charter you, give me all your cash. Banking has to be done in the light of day, and that makes it susceptible to the sovereign's power in ways that other businesses aren't. Final point about the autocracies I want to make is finally a positive note, an optimistic note, which is that these places actually changed from being autocracies to being, let's say, at least proto-democracies in the 1980s and 1990s, both countries. And the failings of their banking systems contributed, actually, to that democratic transformation. That's a positive story. So the banking crisis in Mexico in 1994 and 1995 cost the Mexican people negative net worth relative to GDP in excess of 20%. And it was the beginning of the end of the PRI's dominance on Mexican politics. That's a long and interesting story. In Brazil, the hyperinflation of the 1970s and 1980s created a political backlash against the autocratic regime that ultimately led to the 1988 Brazilian Constitution and further reforms through the early 1990s. So the good news is sometimes the failings of banking systems can actually go, the causality can go in the other direction. We've been talking about how politics shapes banking, but sometimes banking system problems can shape politics, sometimes in a positive way. But I want to emphasize, not generally, but sometimes. Now let's talk about democracies. And of course, the one that you've been thinking about ever since I told you about that magic number 17 of major banking crises is the United States. There are basically three eras of politics and banking in the United States. The first one is fairly brief. from roughly the 1780s until about the 1820s. And it's a period of elite control of specially chartered banks. So banks were initially chartered by legislative action. And particular people were given the rights of being the bankers. And they all operated out of the major cities, Philadelphia, Boston, New York, Baltimore being the major ones. There were very, very few banks. They were run, all in the North, they were run by Federalists, and they were run as basically monopolies. Now, in a country that had just fought a revolution, and also that was very interested in expanding into the frontier, you could see how that wasn't going to last very long. And by the time we get into the 1830s, think Andrew Jackson, we have a very different sort of mentality toward corporations and banks in particular, and towards monopolies. And so we start getting competition to some extent, and at least no longer just charters that are specially given by legislatures that only are given to a particular party of federalists that are only operating in cities. Now we have banks that are going to be operating throughout states, and that are going to be particularly geared toward not just the cities, but also the countryside. Because after all, that's what the populist Jacksonian movement was all about. Now, that what's interesting is that equilibrium that I'm going to describe of creating what sometimes are called free banks, which are unit banks operating at one location typically, allowed to be chartered. If you could apply for the charter and you've met the requirements of the charter, you could operate a bank. So you might say, well, this was a very competitive system. And it wasn't. It was a system of local monopolies. Because if you tell banks they can only operate one office, they have huge overhead costs in their local environment. And typically, a small town can only support one, maybe two banks. Unlike, let's say, in Canada, where from the beginning they had nationwide branch banking. And so banks could send branches, and did, into even the smallest town. So even the smallest town would typically have 3 or 4 bank branches, sometimes more, competing with each other. So the US was structured to have very uncompetitive, although free banking got rid of the special chartering limits, it made banking very uncompetitive. Not only that, but it made banking very undiversified. So that banks located, let's say, in where I taught for a while at the University of Illinois, in Champaign-Urbana, the banks were all making loans either against corn or soy. Even if you were lending to the local merchant, the whole economy is corn or soy. If corn and soy prices go down, everybody hurts. That makes for a very undiversified banking system, which is crazy economically, right? So the banks have big overhead, they have local monopolies, and they're not diversified. Other than that, Mrs. Lincoln, what did you think of the play? You know, not a very good banking system. And yet, they were politically very powerful and very popular. It wasn't just that politicians in smoke-filled rooms supported these local monopolies. Now, of course, you can figure out that the bankers themselves that have these local monopolies want to preserve them, right? But it wasn't just the bankers, and it wasn't just the politicians in some smoke-filled rooms. In Illinois in the 1920s, they had a referendum to preserve that system, and it passed. Why was it that, especially in certain agricultural states, but pretty much throughout the country, because the country was largely agricultural, that agricultural landowners, they were the ones who loved the system. People like William Jennings Bryan, who ran for president in 1896 on the Populist Party and Democratic Party platforms. He was in love with unit banking. Now, why would farmers want to have banks that are undiversified, that have local monopoly power, charge them higher interest rates, pay them lower deposit rates? Why would they want that? And as I said, fewer competitors out in remote areas. Well, the best answer that we can come up with, looking at all the evidence, is that it was a form of credit insurance. That if the banker was tied to soy and corn, then that meant that the banker, if soy and corn prices came down, let's say 10 or 15%, would still be providing credit to you, the soy or corn farmer, because he didn't have a lot of other choices. And so it was a kind of credit insurance where you're accepting that you pay higher interest rates in exchange for getting access to credit in bad states of the economy. That system survived incredible problems, adversity in the banking system. It survived until 1997. We didn't have nationwide unfettered branch banking in the United States until 1997. And we had virtually no branching, almost no branching in the United States as recently as 1980. It was a transitional phase from about 1980 to about 1997. Some of you aren't old enough to remember it. You might think that big banks always existed in the US, but they didn't. They didn't exist until the 1990s. And that's the third phase. The third phase was a different coalition. Just like that second phase was a coalition between some borrowers, land-owning farmers and unit bankers and the government. This new coalition was also a new coalition of bankers, as well as government officials, and also particular debtors. That means borrowers from the banks. And that the difference was that this was an urban-dominated coalition, as opposed to the other one, which was a rural-dominated coalition. So let's look a little bit at the shape of this. You can see that as of 1920, and this is pretty much a picture that I could do for any of this period, we had about 27,000 banks with virtually no branches throughout the country. You can see over time, it's really in the 1980s that we get a decline in the number of banks and a big growth in the ratio of branches per bank. That begins and accelerates into the 1990s. You might wonder what changed in the 1980s and 1990s, and we have a list here. I don't want to go through all of it, but part of it is continuous process throughout the 20th century of people moving to the cities, technological changes and court decisions that made unit bankers lose their local monopoly power, especially the rise of ATMs was a big part of that. Problems of US banks outside the US that made people like Alan Greenspan and many politicians realize that if we didn't allow banks to be big, then on the global stage, our banks would always be losing out to foreign competing banks who were allowed to be big in their home countries. And finally, the banking crises and distress of the 1980s that made it very convenient for the government, through the FDIC, to save money by allowing mergers to happen. So Nations Bank, for example, out of North Carolina, by the way, you may wonder, why are the biggest banks in the country housed out of states like North Carolina? Because they very early on allowed branching within their states. So when the 1980s crisis happened, North Carolina was a relatively well-positioned banking system. And it went to the FDIC and said, I've got a deal for you. I'll buy that bank, and you won't have to pay so much of the cost of the distress of that bank. But wait a minute, you can't buy that bank. It's prohibited. It's not in the same state that you're in. It's not in the same district that you're in. There's some prohibition by branching restrictions. Well, how about relaxing those? And you could see that local politicians who are looking at a lot of failed banks in their backyard might want to do that too. So the FDIC got a gain from it. The local environments got a gain from it. And so the distress contributed to the decision to relax those restrictions. So now we've got, after 160 years of unit banking rural dominance, we've got the unraveling of that system. And now you have to ask yourself this question. Who gets to be a nationwide branching bank? And how was that decided? And the answer is, it's a regulatory game. You don't think that we're just going to let that happen randomly when there's so much money at stake. And so what happens is, new centers of economic power, mainly cities in the US, figure out that they can use a law that's been more or less dormant since it was enacted in 1977. They can use that law to share some of the profits that are going to come from fixing the banking system. That is, making the banking system a nationwide banking system. Here's an example. The president of Acorn Housing, George Butts, is giving a speech about how much he supports the merger of Nations Bank and Bank of America. And what I want to emphasize is this isn't just a speech he's making randomly. He's making a speech at the Federal Reserve Board. So because the Federal Reserve Board has to show, before it approves a merger, that banks are good citizens, and because politicians are watching what the Federal Reserve Board is doing, that legislation empowers local urban activist groups to be part of the conversation about who gets to be a merging bank. The Fed has to pay attention to their views because if it doesn't, Congress will threaten the Fed's independence. That is explicit. And so these groups end up in a very strange position. You might be surprised to hear that grassroots local community groups are supporting humongous bank mergers. And how do they know that these guys are good citizens? Well, it's very easy. They're good citizens because they gave us a lot of money. That's the best evidence. And so how much money did they give between, let's say, 1992 and 2007? Well, guess in your mind. The answer is $2.4 trillion. And how much of that was given specifically at the time of a merger in exchange for the activist group showing up to testify in favor of the merger? About $900 billion of it. These are explicit contracts. They typically went for about 10 years, about directing credit, allowing the groups to manage, to funnel credit to wherever they wanted, or about 10% of that money was just grant money. There's a lot of money at stake. And the way this worked was politicians also realized in the early 1990s that the banks would be willing to give bigger money to these groups if we could get Fannie Mae and Freddie Mac, which were also federally regulated banks specializing in secondary mortgages, if we could get them to buy a lot of the mortgages that the banks were agreeing to make in these deals. And so in 1992, Congress created the GSE Act, and President George H.W. Bush, fighting for his life in the presidential election of 1992, signed it, hoping that it would get him some friends in cities. Note Rand Paul, a few months ago, said, Republican presidential candidates have to understand that they can't win unless they win cities. Because guess what? There's cities in Ohio and in Florida. And it's not just city residents or lower income residents that are associated with some of this. It's not just them who are getting the advantages. We learned that from somebody like Newt Gingrich, who was all in on this deal. He represents a suburban Atlanta district and very much had his incentives aligned with urban issues. So the divide, when we look politically at who's in favor of this deal, is pretty much an urban versus rural deal again, but now it's the urban group that's in control. Now the GSEs, Fannie and Freddie, are finding as the money starts getting really big here that they can't absorb these mortgages under their existing credit standards because there are too many bad mortgages. And so they have to relax those standards. And they relax them in two ways. They say that people can get mortgages even though they have no documentation. Those are sometimes called liar loans. And they also say that you can get a mortgage even if you don't have any down payment. So if you have no documentation, no down payment, you can have a mortgage. And they had to do that when they relaxed it. They had to relax it for everyone because they were pretending that these rule changes were not destabilizing, were not really very risky. So they didn't just target to meet their obligations under the GSE Act. They didn't just target it to select groups. They made it true for everyone. This gives you an idea of the size of those specific merger agreements and how they grew over time with the merger wave that's happening. That's basically a picture of the merger wave. And this gives a picture of the GSE mandates starting in 1992 that are targeted toward particular urban groups, lower and moderate income groups, but also underserved areas, particular urban areas. And these are not mutually exclusive. So what they're telling you is that more than half of Fannie and Freddie's portfolio has to be these identified groups. Fannie and Freddie, in their final settlement with the SEC, because they committed fraud they tried to pretend they didn't have a lot of risky mortgages, even though they were doing this, they admitted that they had $2 trillion worth of high-risk mortgages. This gives you a sense, what percentages of mortgages had 3% or less down payments? Well, in 1990, almost zero, but by 2007, 40%. And I think I'm going to have to stop pretty soon. How much more time do we have? Okay, stop at 6:30 for Q&A. Good. So now I want to talk a little bit about Canada. Why didn't Canada get into all of these various problems that the US got into? And at a superficial level, the answer is Canada always had centralized government control over banking that always allowed nationwide branch banking and that always insulated the banks from these kinds of pressures about who they should lend to or whether they couldn't branch, all of these kinds of restrictions that first the rural groups and then the urban groups pushed for, we don't see happening in Canada. In fact, Canada is practically a model of the best regulation that we've ever seen in the world in banking systems. I could go on and on about it. But that's not really an explanation, is it? After all, the US was looking right across at Canada the whole time. We even established a monetary commission in 1910 to try to figure out how to get our banking system to stop blowing up. The National Monetary Commission. And they commissioned scores of books, 3 books just about Canada. And those books all pointed to what I'm telling you. Canada was more stable, it had a better regulatory system. And so you might think the National Monetary Commission would have proposed that the US adopt the Canadian system. They didn't, because that would have been dead on arrival at Congress. So what they proposed instead was a sort of second best, which was to create the Federal Reserve System, to try to help a little bit on the margins. The main thing the Fed was designed to do was to limit seasonal liquidity risk in the lending market, which it did very successfully. But it didn't solve the problem of instability, and even the National Monetary Commission knew that it wouldn't. Of course, we had a lot of instability in the 1920s in banking and the Great Depression as well. So why didn't this happen in Canada? By the way, all of the attempts that were happening that were succeeding in the US, they were attempted in Canada too, but they always failed. Why did they fail? Well, the Canadian Constitution is the main reason. The Canadian Constitution has a Senate that still, to this day, has control over economic legislation. That is, it can block anything that it doesn't want. And it's still appointed by the Queen of England. It's a good trivia question for you. Who elects the Canadian senators? Nobody. Now, I could talk about the Canadian Constitution quite a long time, but the main point is the Canadian Constitution has been very successful at keeping banks from becoming political footballs. Now you have to ask why. Why did the Constitution, why was it designed that way? And the answer is pretty simple. Britain controlled the evolution of Canada politically, and Britain's main problem from the beginning was that Canada was won by Britain in 1759, and it was populated by people who hated the guts of the British, called French Canadians. And the problem was that any sort of democratic system that would give the French Canadians a lot of power would also mean that the French Canadians would use that power in a way that would be subversive of British interests. In particular, Quebec is at the chokehold of getting out of Canada. If you want to develop the west of Canada, you have to take it through Quebec. So they were blocking all the canal projects and other things, and they even tried a little revolution in 1837. And then Lord Gosford comes over from the Privy Council, from Parliament, and he's talking to everyone. He figures out the answer. The answer is to merge Canada, which they do first in 1841, to dilute and change the voting rules to dilute the French influence. And the Canadian Constitution in 1866 does this by bringing in lots of other provinces. To make a long story short, they had an enemy within, but they didn't want to just be an autocracy forever because you couldn't get Brits and others to come to Canada if it wasn't a democracy. And so they created a liberal democracy. But if we're trying to understand why they created a liberal democracy, we can. It's a combination of the history of colonial settlement, the fact the French were there first, and the geography of Canada that gave those French residents in Canada a lot of power to block Canadian progress. The Canadian Constitution was the answer. All of the same bad ideas in banking that worked in the US came up in Canada, and they all ran aground in the Canadian Senate, time after time. I'm not going to talk about the UK because we're running out of time, but I do just want to say, I won't talk about it in detail, but just say a little bit about it. If you thought, how many of you thought that given that both the US and Canada can trace their origins to the UK, we had the Bank of England, a very famous institution, chartered in 1694. I told you that the Scots were doing all this great innovation in banking. You probably thought that England was, and since the beginning, a great bastion of banking success. Well, the answer is it wasn't. And in fact, it's gone through 4 very different phases of economic development. And England has only been, and Britain generally, but London in particular, has only been a global banking powerhouse really since the 1980s. For its early history, the main thing to recognize is that the Scots were sort of left to their own devices in exchange for deciding to commit unilateral disarmament politically, that is, get rid of the Scottish Parliament in 1707. And basically, the king could be comfortable with the Scots, didn't force them to hold a lot of his own debt, in fact, none, as long as they didn't make trouble. And so they were allowed to go and have a competitive banking system on a branch basis, innovate, develop all those things that I mentioned before. But England and Wales could not have a competitive banking system. And the function of the Bank of England until 1815, was to fund the war against France. After the war with France is won, people start saying in England and Wales, why can't we have a banking system like Scotland? And so they get one, starting in 1826 and going on again in 1833, and so on. And Britain does have, in that second phase, a very successful banking system. But then, with 1910 through 1970, as a result of wars and some other changes that happened politically, with the rise of populism in Britain, it's a long story, we basically get the banks become a sideshow. We nationalize industries in the UK. The banks aren't really a very important vehicle for economic development during this period. And it's not until the Thatcher years, really, of privatization and the strategy of allowing London to become a global financial center that you get back to an important sort of banking function in the UK. So again, 4 very different periods and driven by fundamental and far-reaching political changes. I'm going to skip through those. So here we're at the end. Democracies, how to think about those. Expropriation risk is low, unlike autocracies, because you're not going to go steal the bank from the guy. That's hard to do in a democracy. Inflation taxing, like in Brazil, is also very low, because inflation taxing is very unpopular too. But in democracies, although that means they tend to have much more abundant credit, the problem is that in populist democracies like the US, they tend to be very unstable, because one group, initially rural, later urban, tends to use the banking system to create very unstable kinds of arrangements that are in their own private interest. And the sort of depressing endpoint, of course, is that because this is a political equilibrium, this is a game being played in Washington, it's very hard for us economists to change it just through the force of ideas, through the recognition that these regulatory arrangements are dysfunctional. What we all need is you voters to do it. The problem is the voters don't often even know what the deals are, much less whether they agree with them. And so our regulatory discussion needs to be very different. It's not a discussion about more regulation or less regulation. It should be a discussion about what's really going on, who's really served and who's not served. And in particular, we need to stop bashing the banks. Yes, the banks have been always are part of these political deals. But never in a democracy can the banks by themselves make the rules. They always ally themselves with particular groups of debtors, agricultural landowners or urban activist groups. And that's the political reality of what you have to do in a democracy. Thanks very much. Let's have some questions.
Thank you.
So if you have a question, if you'll just hold up your hand, I will bring the microphone to you.
Hi, my name is Chris. I'm not affiliated with the university in any way. I'm just a curious person who wandered in. Question about the Acorn statement about the merger. It sounds a lot like some press releases I saw back in those days about conditional approval of B of A buying out Fleet Boston and some other mergers. And your chart also seems to pick up in the late 90s. I'm wondering, this is such a coincidence, does this have anything to do with CRA, Community Reinvestment Act? And
Yep.
Would you say that CRA might have been one of the prime enablers of the post-90s thesis you just covered?
Yeah, so that was the dormant law I was referring to, the Community Reinvestment Act of 1977, which, as you can see, for many years did not result in any of these contractual arrangements. It was not until the bank merger wave gave a new opportunity through the CRA for the activist urban groups to really be able to get their payday. So yes, I think it was important. But also, these volumes wouldn't have been as big if the GSE Act hadn't forced the GSEs to buy a lot of this stuff. The banks wouldn't have been willing to do 2.4 trillion of this if they had been forced to keep it all themselves. And that was very much the point of the GSE Act. I mean, just follow the dots. Read chapter 7 of our book. You can see that the architects of it, intended it to serve that role. They wanted to make those numbers bigger in the early 1990s, and they succeeded. So this was very much an intentional design. The CRA was not designed by Jimmy Carter with that purpose, but it was a convenient tool once the merger wave began. I also want to emphasize, this was not, I've already said it, but just let me double say it. This was not a partisan issue. This was an urban versus rural issue. If you were a Democrat, basically you were all in, because the Democrats are largely an urban-based party. If you were a Republican that was in an urban area, you were all in, pretty much. If you were a Republican running for president, you were all in, because you need Ohio and Florida. If you were a rural Republican, you were against it. Jim Leach, Shelby, Graham, Richard Baker from Louisiana. So you can kind of see that it was, but people like Gingrich, who were in very powerful positions, could have opposed it, but didn't. So yes, they knew what they were doing. And it wasn't just Bill Clinton. George W. Bush expanded this hugely. And yes, it was very much a combination of the CRA and the GSE Act working together, as intended.
Yes, I just wanted to ask you a question. You mentioned China just briefly in your talk earlier. I just wanted you to comment more specifically on that, developments going on there.
You know, we have a little section at the end of the book, chapter 15, where we talk a little bit about China. China's an autocracy. The banking system is still largely a tool of the state. You can't look at the credit statistics of the banks and think of them as private credit in a normal sense. They're being used by the state to direct funds to finance state-owned enterprises very unprofitably. That's the main function. The problem with the Chinese banking system is that it's trying to serve two masters. One of them is that master, and the other one is trying to promote growth. So you notice China has now lowered its growth forecasts. It's starting to finally hit a diminishing return point, and it knows, and it has known for some time, that it needs to liberalize the banking system. But the problem is, to liberalize the banking system, you actually have to stop subsidizing these loss-making state-owned enterprises. That's very politically difficult because that means a lot of people would lose their jobs. And if you think the Chinese rulers are just dictators, you're wrong. They rely on stability. They rely on not creating a populist revolution to unseat them. And so they're very sensitive to employment issues. And especially, this is true of local officials. So the Communist Party and the way it reproduces itself is very wrapped up with the banking system. And that limits the ability of China to grow, and it limits the ability of the banking system to become rationalized. The thing is that unlike a lot of other countries, though, they're not going to have a major banking crisis because they have trillions of dollars of cash sitting in the People's Bank of China. So even if they had a repeat of their 1999, about $300 billion worth of loss, pretty big number coming from these bank loans made to these state-owned enterprises. So it's likely that they are sitting on unrecognized losses that are even larger right now. But they're not going to have a crisis because they have trillions of dollars with which to absorb them. But the real problem is not the loss absorption of the fiscal capabilities. The real problem is that they're not using the banking system as well as they could. They're also getting all this shadow banking developing and municipal debts where there's a moral hazard play, where the municipalities are issuing debt with the implicit protection of the national government. Well, they're trying to shut that game down too. So we're really starting to get to the end of the game right now. And actually, the only short position I have in my portfolio right now is Chinese equity. I could have given you a much shorter answer.
I am shocked that I don't see more hands up right now in this group.
Hello, it's loud. My name is Kayla, and I want to thank you so much for your lecture. I heard a lot of things that I needed to hear, trying to figure a lot of this stuff out as an economics student. And I'm just wondering, right now, where you stand on time banks as an alternative. And correct me if I'm wrong, in your solutions or conclusions, I heard a lot of increased transparency in what's going on in banking and regulation. And I was just reading the other day something about Dr. Sachs at the Earth Institute funding a few projects, research projects on time banking. So just wondering if you include that in your solutions.
Did you say Thai banks as in
Time banking?
Time?
T-I-M-E.
T-I-M-E. So I don't know what my friend Jeff is up to with time banking, but I can tell. Could you give us a couple sentences about it?
Yeah, it basically just reevaluates what is monetary value or units. So people are often trading services for other services instead of dollars for dollars, and it's a proposed solution or paradigm shift really to the current banking situation.
So it's it sounds like it might be even a little bit of a barter system using.
Old school.
Yeah. So I guess here's my general take on. I'm going to generalize your question because I don't know a lot about this specific one, but I can talk about sort of the broader question of, can we get around a lot of these problems with new innovations in banking? And the answer is, we're seeing some examples that are pretty promising. So the one that I would point to that's the most promising is a bank in East Africa called Equity Bank. So Equity Bank has figured out something that's very challenging, which is when you're in an environment where the rules are really bad, your contracts aren't enforceable, it's very hard to track what's going on with and to enforce your loan agreements. And so in those environments, prior to Equity Bank, what we were stuck with was various kinds of what are sometimes called microfinance arrangements. Now, those microfinance arrangements are kind of self-enforcing. They don't rely on the law. They rely on other mechanisms. The problem with them is they're small potatoes. I mean, it's not that the mechanisms are bad, but they can't really be scaled up. They can't really deliver much for reasons that I don't have time to go into. What's interesting about Equity Bank is that they found a way to do that. And the way that they're doing it is a sort of, you might find it a little unsavory. It's sort of a big brother kind of mechanism. So they make you as a customer, they'll give you a little bit of money, lend you some, but you have to maintain your whole life with Equity Bank and through a cell phone that's provided by Equity Bank. All of your major transactions are going to be done with that cell phone. Equity Bank is going to track every spending that you do. Your salary is going to be direct deposited in Equity Bank, and you will have no other banking relationship. And what that does is effectively it allows Equity Bank to avoid even needing legal enforcement because it has control over your whole life and can monitor what you're doing. And when you start going a little bit off, they call you up and say, I noticed you just bought that hairdryer. No. Say, take it back. So not joking. And what's interesting is they've actually managed to, without a lot of the traditional bank enforcement mechanisms, to actually have a fairly successful system. For the most part, though, my take on most of the innovations in banking, sometimes people ask me about Islamic banking, sometimes they ask me about microfinance. My take on this is that these might be helpful, and I'm all about economic freedom and letting people try new things. But to be honest, commercial banking is a very successful, tried and true technology that we know from evidence in the world today is one of the best tools we have for reducing poverty, for increasing equality, for giving small businesses a real chance. Not just microfinance where you're doing some trinkets, but you go from trinkets to building a small business. And not just in San Jose, but in East Africa. And so let's use that technology. It works. But the problem, of course, is politically, it's not always so easy. And that's why, when you can't get the political solution, try these new innovative things. But I'm sorry I couldn't answer your question more directly.
Okay, that takes us actually to the end of our time. So in the interest of being on time, you are welcome to join us at Flames and carry on this discussion. And we look forward to seeing you there. Thank you for coming tonight. Let's have a hand for Dr.
Thanks. I appreciate it. Thank you. Thanks for your attention.
We will see you all on April 22nd. Thank you.